Welcome to Credit Unit 4, Module 2. In this module, we'll be looking at financial resource management. Since finances are the underlying engines of all businesses, it's important that anyone interested in business have an understanding of how they work. First, we'll take a look at money itself. Money serves three functions. It's a medium of exchange, a measure of value, and a store of value. Money has no intrinsic value on its own, but we as a society have decided to let money stand in as a sort of abstract representation of value because it greatly simplifies the process of trade. In order to track money, the government uses two measures. M1 represents all money in its most liquid forms like cash and checking accounts. M2 includes all of M1 plus near cash items like savings accounts and time deposits under $100,000. Financial institutions help money get to the people who need it. These institutions fit into one of two categories: depository and non-depository institutions. Depository institutions include commercial banks, savings banks, and credit unions, and allow people to deposit money, which they then use to lend to people interested in borrowing it. Non-depository institutions, which include finance companies, insurance companies, and brokerage firms, may also lend money, but instead of getting their funds from depositors, they acquire funds by selling securities or borrowing the money themselves. Because banks lend out the money they have, it's said they expand the money supply. This basically means that when you deposit money in the bank, you still have that money in your account, but the bank lends most of it out to someone who can make use of it also. It's almost like the money's in two places at once, and this can continue further down a chain, creating a multiplier effect. The Federal Reserve, or the Fed as it's called, is in some ways like a bank for banks. It's in charge of monetary policy and works to promote price stability, sustainable economic growth, and full employment. It has three main tools it uses to do this. It can change the reserve requirements of members' banks, which is the percentage of money deposited a bank must keep on hand. It can change the discount rate, which is the interest rate the Fed charges banks to borrow from it. And it can conduct open market operations, which is the buying and selling of government securities. These tools give the Fed some control over how attractive it is for people to borrow and spend money. If it's too attractive, we can wind up with high inflation. Not attractive enough, and the economy will slow down. Then we'll look at how companies raise funding. The first step is to develop a financial plan that estimates how much money you'll need and how you plan to get it. New businesses are usually financed through the owner's personal assets, loans from family and friends, and bank loans. If a young business shows a lot of potential, more funding can be raised from angel investors and venture capitalists, both of which invest in startups that show a strong potential for delivering large returns. If things go well and more funding is needed, selling stocks and becoming a publicly traded company is another way to raise a lot of money quickly. Stocks are a kind of security, and as such are traded on a securities market. When a company initially sells its stock during its initial public offering, or IPO, it uses a primary market, and all the money paid for the stock goes to the company. Once investors own the stock, they can trade shares through a secondary market, but the company doesn't receive any money from these trades. This is not to say that managers don't care about the price their stock is trading at. How well their stock is doing is a good indication of how well the company is doing, and usually managers in a company own a good deal of stock in it themselves. Selling stock to raise money is called equity financing. The company receives money, and the investor receives equity in the company. The company doesn't have to repay the money it receives, but the shareholders are now all part owners in the company and can have a say in how it is run. Another option is called debt financing, and this can be done by issuing bonds. Issuing bonds is a lot like taking out a loan. They need to be paid back and with interest, but on the plus side, you're not selling off any ownership in the company. Then finally, we'll look at some careers in finance. Careers can be in commercial banking, corporate finance, or the investment industry. After you read the chapter, you may have a better idea of how appealing this is to you. So, without any more delay, on to the reading.
Created using Powtoon.